Good morning and welcome to today's webcast, Prepare for the Medicare Wage Index Reclassification of 2028. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And as we get started today, I wanted to highlight that Baker Tilly and Moss Adams have joined forces to create something greater. One firm with the resources, expertise, and vision to better serve the middle market. To learn how we're unlocking opportunities for businesses, please visit our website via the link in the slide deck and handouts widget. This is more than a merger, it's a multiplier. And with that, I will turn it over to Brian to get us started.
Thank you. So thank you all for joining and welcome to our webinar today on Medicare Wage Index. We're happy that you joined as we will discuss the purpose and timing of reporting, as well as some key topics and best practices on the Medicare Wage Index factor and how it impacts our payments. As we begin, I'd like to introduce our presenter today. My name is Brian Bodi, and I am one of the directors of Baker Tilly's Healthcare Consulting Group, focused on reimbursement issues. Also joining me are 2 other directors, David Gepper and Brian Restivo. We've all worked in the Medicare reimbursement space for many, many years and are pleased to be able to present to you today. So I'm going to go over today's agenda where we're going to run through some key factors surrounding Medicare Wage Index. I'll be covering the first 2 items on the agenda. What is the wage index, and then also go over some key wage index timelines in reference to Medicare's purpose and use of the wage index data for our participating hospitals. Then I'll hand it over to Brian, who will share some insight into special circumstances and reclassification rules and opportunities. From there, David will review the wage index prep process that hospitals should be and need to be familiar with. And then finally, back to Brian to wrap up today's presentation with some best practices, current hot topics, and how we can help providers maneuver through for positive results when dealing with the Medicare Wage Index rules and regulations and how it impacts our payments. So what is the Medicare wage index? So we're going to jump right in and see how much we all know right away with the first polling question. What is your level of familiarity with the impact of the wage index on your hospital reimbursement rates? Please go ahead and complete the poll as quickly as you can, and we'll kind of go over the results. I'm seeing about 65% so far. Getting closer, about 80% so far. Winding down, we got about another 15% to go. If you want to answer this first polling question or get one of them out of the way. And a few more minutes, seconds. All right, in the interest of time, we're about 91% of attendees have answered. What is your level of familiarity? Very familiar, somewhat familiar, or not familiar at all? We'll go to the next slide. So it's a pretty good mix. Somewhat familiar is the average, 50% of the total. Some of you are very familiar, not familiar at all, which is very understandable. It can be a complex issue. So we're hoping that with this presentation today, will help share some more insight as to the process and importance as to why Medicare uses the wage index from our hospitals. So what is the main purpose? So the main purpose of our Medicare wage index is to adjust your inpatient and outpatient base rates for acute care facilities to account for the relative differences in each of the labor markets' average hourly wage versus the national average hourly wage. So Medicare uses the full picture of all national average hourly wage from our cost reports. So when even a hospital may experience increases in your operational salary and benefits, you can see a net positive reimbursement impact down the road. Adjusted salaries and hours for each hospital and each of the CBSAs are then combined to provide the totals for that particular area in which your provider is located. Hospitals can and do impact and drive net revenue through this process of the Medicare Prospective Payment System payments. The wage index is based on historical cost report filings. Although keep in mind there is a lag between the salary and benefit changes and the ultimate impact on your reimbursement. But these factors are updated annually in our base rates. And finally, not only for acute care hospitals, but the wage indexes are impacting their rates for ASCs, home health, hospice, inpatient psychiatric facilities, rehab facilities, as well as long-term care facilities. So the calculation is a key thing that we should try to understand. The timing of, I guess, is the best way to approach this. It is a drawn out process on when it actually impacts your rates. It's based on data from our hospital cost reports. There's a large lag between the time that data is submitted on your cost report and then is used for wage index factors by CMS. There's about a 4-year lag between each cost reporting year and then when that data is used to calculate our wage index factors. For example, federal fiscal year 2027 wage index is based off of cost reports that begin in federal fiscal year 2023. And then 2028's wage index cost reports or wage index is based off of cost reports that begin in federal fiscal year 2024. There are multiple changes or adjustments that Medicare applies to that raw data when they are submitted. There's inflation adjustments, allocation for overhead wages and hours to some non-allowable areas. Occupational mix adjustment. I think if many of you may have joined Brian and David a couple of weeks ago on the occupational mix surveys. Those are important, as well as budget neutrality adjustments. Wage index updates are effective based on every federal fiscal year. So for inpatient PPS, that'll be October 1st. And then for outpatient APCs, that will be impacting the 1/1 every January 1st outpatient reimbursement rates. So the basic data that is used to help create a wage index factor, you have the adjusted salaries and hours for every single hospital nationally combined. That calculates the national adjusted average hourly wage. Then the adjusted salaries and hours for each hospital within a core-based statistical area, or CBSA, are combined to provide those totals for that particular CBSA and calculates an adjusted average hourly wage for that area. Then each of those areas adjusted is divided by the national average hourly wage to come up with the wage index for that specific CBSA. Then that will be further adjusted by any budget neutrality factors. Some key items to be familiar with as far as location of your provider or of your hospitals, core-based statistical areas. So basically, hospitals fall into specific geographic areas and are based on what the Office of Management and Budget has defined as core-based statistical areas. You'll see terms like MSA or Metropolitan Statistical Area, certain definitions that make up urban areas, the largest MSAs divided into certain metropolitan divisions, what a rural area is, and then there's even urban-rural status that are adjusted and redefined every 10 years. And then as far as how do they delineate, CMS did finalize the delineations on a recent 2023 bulletin that was based off of 2020 census. And that was started using that beginning federal fiscal year 2025. There are approximately 470 different urban and rural areas as defined for the purposes of inpatient and outpatient PPS wage rates. So for federal fiscal year 2026, we didn't see too many changes in policies. As an example, updated use data from cost reports beginning in fiscal year 2022 was what drove the fiscal year 26 wage index. So there's your 4-year lag that we discussed. 2026 final unadjusted national average hourly wage was $57.92, which is about a 5.5% increase over the prior year. CMS is then using the 2022 occupational mix survey currently. They used it for 2025. They used it for 2026, and they will use it again for 2027 to make the occupational mix wage adjustments. And then the final adjusted national average hourly wage for that OC mix became $57.86. We noted that there's about 1,100 or so hospitals that were approved for the wage index reclassifications for 2026. The bottom graph kind of shows you a picture of how these rates have increased. If you go from right to left from 2021 to 2026, a gradual increase over time of the national occupational mix adjusted average hourly rate has gone up from about $45.23 to almost $58. Here we have an example of how the wage index calculation may be calculated for a certain CBSA. Now, we're not picking on 2540-420 CBSA. It's the Harrisburg-Carlisle CBSA. We just use this as an example. This is public information, so anybody could try to tick and tie some of these data if you want. But basically, it shows the geographic wage hospitals in that area come up with an average hourly wage of $57.79. You take the national average at that time was $57.86. There's a wage index which calculates the wage index prior to any rural floor budget neutrality adjustment. You use the rural floor budget neutrality factor that's published at 0.9740 to come up with an estimated wage index for that area pre any reclasses. It appears there was a couple hospitals that were reclassed and approved to go into that CBSA, which then you have a combined CBSA average hourly rate of $56.08. So from there, you use the same calculation of the national average hourly wage to get a reclassified wage index. You apply the rural floor budget neutrality factor to come up with a revised estimated wage index for that CBSA at 0.9440. Some key timelines to be familiar with that are coming up in this fiscal year that have to do with 2028's wage index. We have May 22nd. There will be a release of it's expected the preliminary data from the unaudited 2024 cost reports will be published. And again, as David and Brian discussed on the OCMIC survey presentation a couple weeks ago, currently you should be working on your 2025 OCMIC surveys for filing by the end of June 30th of this year. About a month and a half later, we should see a release of that prelim data for all hospitals that filed the surveys. And that updated data and also the cost report information will have a deadline of any requests or revisions to your MAC by September 1st, 2026. Again, this information is both from 2024 cost reports, 25 OCMICs that will then impact your 2028 wage index timeline. As I mentioned, this is public data, so we just wanted to point out that wage index public use files, or PUFs as they're considered, CMS does publish your cost report data related to S3 Part 2 and 3, which is where all your data is submitted and audited, and then the occupational mix survey. These are all posted on the CMS website, and you typically see about 4 different publications of the same time frame throughout the year. The first one is the unaudited data. Then you'll have an audited version, and then even after the audited version, if there's any revisions, they do another publication before they give out the final PUF information. So that kind of concludes my area of the presentation, and we're going to hand it off to Brian, who's going to review some special circumstances and reclassifications. Brian?
Thank you, Brian. I appreciate you taking the beginning part of this conversation. Again, just to kind of stress what Brian spoke about with the importance of all the reclassifications and wage index and the impact to your hospital's net reimbursement. So what I'm going to start with is a bunch of certain special circumstances, as I call it, different scenarios for different types of hospitals. And there's a plethora of different nuances when it comes to the wage index and how hospitals are ultimately paid. One of the bigger ones that has been a hot topic lately is the rural floor. And that's the CMS regulation in which no urban area can have a wage index lower than the state's rural wage index. And essentially what that means is that if the rural wage index is higher than any other area, that urban areas that are below will assume the rural floor calculation. Now, there are 4 circumstances where there are no rural areas, but CMS does still calculate what they call imputed rural floor. So for those in Delaware, New Jersey, and Rhode Island, and DC, there's technically no rural areas defined by the government at the federal level. So CMS goes through and calculates what that would have been. The other big thing we see out there with wage index is reclassifications, where hospitals have the ability to reclassify to a nearby area, and I'll kind of go over the criteria. But what this does is create different strategies throughout the wage index landscape. Brian mentioned before, going from urban to rural, or urban, rural to urban, and things of that nature. So there's multiple different strategies hospitals take a look at from the wage index standpoint to drive up their wage index. Another nuance that we have out there that's become common is the out-migration adjustment. And that's what Medicare calculates if you are in a certain area that has a high percentage of hospital employees who reside in a different county or different CBSA with a different wage index. So certain areas will have this out-migration adjustment added to their wage index as part of the underlying regulations. And another nuance we have is what we call the frontier states, and that's Montana, Nevada, North Dakota, South Dakota, and Wyoming, that all have at least a 1.0 minimum wage index. And the key here is that that's a floor and not a ceiling. So a lot of times the hospitals within these states don't, they take a little backseat when it comes to reporting wage index data. However, these areas can go above 1.0, so the reporting of your data accurately is still very critical when preparing your cost reports, because we have seen circumstances where hospitals have lost opportunities for reimbursement just because of the lax reporting. Briefly mentioned before is the urban and rural reclassifications. There's a multiple reasons why hospitals may pursue these types of reclasses, anywhere from medical education reasons to wage index. We can speak about it at length, but in short, hospitals that have an urban and rural reclassification are able to use the more lax rural criteria for submitting their wage index reclassification. So there are sometimes benefits from doing urban and rural from a wage index standpoint, but there's also other benefits and nuances you have to be aware of with that. I kind of spoke about this a little bit just a second ago about that out-migration adjustment, but CMS also identifies Lugar counties, and these are the hospitals and counties that have a high number of residents that commute to adjacent areas, which are urban. For the purpose of wage index, these areas would be considered urban for wage index purposes. However, that Lugar hospital has to make a decision whether it wants to stay as a Lugar hospital and be treated as urban, or cancel its Lugar status and receive the out-migration adjustment that it would have otherwise. So you can't have both, and it's not always better one year versus the next. So if you do waive your urban status, then you would be treated as rural for all other IPPS purposes. So you can waive that designation once over a 3-year period, that out-migration adjustment is effective. So it's critical to look at beyond the numbers that are out there with the published tables to ensure that you're getting the best possible scenario for your hospital if you are designated in a Lugar county. More recently, we've had a change with how CMS calculates the rural floor, and this has changed over the years. But essentially, each state's rural floor will be a calculation, and it's essentially a best of scenario or a higher of scenario, where CMS goes through multiple different calculations to determine what the rural floor is. And this is where certain hospitals' Medicare geographic reclasses or urban and rural reclasses come into play. So there's a multiple different calculation scenarios one has to consider depending on how their hospital is classified and or reclassified when it comes to the rural floor. So we have seen states like New York where everybody's getting paid the rural floor, but that can change year over year depending on who is going in and out of reclassifications or submitting urban and rural reclasses. So it's critical to not just keep an eye on your particular hospital in these circumstances, but your neighboring hospitals and other hospitals within the state for that matter. It's a lot of data to manage through, but if you are not focusing on the data as a whole, it could become detrimental depending on your scenario. And each state, each area is different. So as much as I'd like to give kind of straightforward advice, it's really very, very specific to your area, hospital, and state, whether or not the options are best for you with a reclass or not. When we talk about reclassifications, this is the hospital's ability to go to a different CBSA market to obtain a better wage index for its hospital. The applications are due to the Medicare Review Board the first business day of September. You can withdraw the application at any point before the board approves it, or you can actually withdraw your application within 45 days of the proposed rule. Now, the nuance here is that 45 days is when it's put online by CMS. It's not when the rule is published anymore. So it's critical that once CMS puts out the proposed rule on its website, you have 45 days to review the data and determine whether or not that reclassification is still to your benefit. So the other thing to note is the applications are good for 3 years unless you terminate sooner. You do have the ability to terminate them on an annual basis, and I'll talk about that scenario in a little bit. What I have up here on the screen is the criteria. You can do different types of reclassifications, whether it's an individual hospital, which is the most popular. You can get together a countywide reclassification, and technically you can do a statewide reclass, although I don't believe we have any that are actually done anymore. The criteria will change depending on how your hospital is identified, whether it's an urban hospital, a rural hospital, if you have RRC status, or even if you're a sole community hospital. So the mileage between those different types of hospitals will change depending on how you're classified. And the criteria to move out of your home CBSA has to be either 108% if you're urban, or 106% of your average wage if you're rural. Now, the sole community hospitals benefit from the ability to not have to meet that criteria. So there's different reasons why hospitals are trying to obtain certain special statuses, and wage index is one of them. In addition, you have to meet certain criteria of the area you want to move into, meaning if you're an urban hospital, you have to be 84% of that market's average wage over a 3-year period. So there's different criteria, not just an automatic reclassification available to you. And again, how you have your hospital designed from a standpoint of designation, what urban or rural or special designations will drive what qualifications you have to follow for a reclass. When it comes to reclassifications, there's actually 3 separate calculations that could come from reclasses. And again, this is going back to my comment before that it's not just what your hospital is doing in the reclass world, it's everybody else. So if all the hospitals that go into an area cause the average wage to be less than 99% of its calculated rate, there'll be a separate wage index that is created for just those reclassified hospitals. The geographic hospitals that are in that market are always held harmless and not harmed by any reclasses in or out. Now, if the calculation becomes that the average wage is between 99 and 100%, all the hospitals will get the wage index that's computed from the geographic hospitals. However, what we've seen over time is that there's instances where reclassified hospitals drive that market above their 100% mark, meaning the reclassing hospitals into that area help them out, and everybody benefits in that scenario, and all the hospitals that are in that market or reclass that market get a higher computed wage index. So again, those that are geographically located are held harmless, but there is a potential benefit from that. And lastly, kind of just a quick case study and the importance of looking at wage index annually and not just every 3 years. And this is critical and kind of the high horse here is that we've had hospitals out there that thought they were in a better position with a reclass, but they didn't look at it every year. In this case, you had a hospital that was reclassified from urban to rural. And since they didn't want to get paid the rural wage index, they went to a different market and not their home market. And what ended up happening, instead of looking at the wages every year, what was out there for reclasses, their home market was actually better than the area they were reclassifying into. And what this ultimately happened was they lost about $5 million in Medicare reimbursement per year over that 3-year period by not checking in on the potential scenarios each year. So it's very critical to not just rely on that every 3-year application period, because things are changing around you and within your own facility that can drive that number significantly in the wrong direction. At this point, I'm going to kick off the next polling question here, and we'll keep this up here for a little bit until we get about 85% of folks to participate. Does your hospital review your wage index reclassification annually? And you've got the three options up here. And again, while you're taking this survey, again, can't stress enough to look at this stuff annually as to not leave any opportunities on the table. So we'll let folks here get some of their answers in for the polling question, and then we'll move on here in a moment. We're about 72%. We'll give folks maybe another 30 seconds to get their answers in so we can keep the train moving. About 81. We'll give it another 20 seconds or so, and then we're going to turn it over to the results and see what we look like. And then we'll turn it over to David Gepper, who's going to talk about the wage index preparation here in of itself in a little bit. So we're gonna move on. We've got a majority of the folks who are on participate in the poll. So we're going to get the results up. So yeah, it's about half that look at it every year. So we got about 20% that don't. So again, it's just want to stress to make sure that you guys are keeping an eye on it. And those that don't qualify for reclassification, so making sure that you're checking into that every year, because your criteria may change and your factors may change that could change that response. So with that being said, I'm going to turn over to David, who's going to talk a bit more about the actual data that drives the wage index and what goes into the cost reports. So David.
Excellent. Thanks, Brian, for the insight. So over the next group of slides, I'm going to discuss some basics and standards typically associated with wage index preparation. So salaries for wage index review are reported on an accrual basis, which would be representative of costs reported in your facility's general ledger for the cost reporting period. The corresponding hours must be reported on a cash basis, or that is, hours paid in the fiscal year based on the payroll report. The payroll report should include hours associated with costs expensed in the prior year, but paid in the current year. And there should not be any calculations needed for accrued hours. So let's discuss what types of expenditures are included in the Medicare wage index. All salary costs for employees should be considered for inclusion in the review. While salary costs are mainly representative of regular pay, expenses for holiday pay, paid time off, jury duty, bonus pay, shift differential, and premium pay, as well as severance pay, must be included in the wage index. Related party costs for home office salaries and benefits, as well as any other related entity providing staffing to the hospital, should be considered. A vital part of the review process is accurately identifying and including expenses for employee benefits such as retirement plans and insurance coverages for health insurance, dental, vision, and hearing insurance. Employer-paid taxes are another crucial benefit expense that need to be captured. Costs in tuition reimbursement should also be considered for inclusion in the wage index, as well as daycare expenses. We'll dive into more detail about reporting benefit costs later in the presentation. Another major component of the wage index is contract labor. Expense for contract direct patient care services, top-level management, housekeeping, dietary, administrative in general, and contracted physician Part A expenses all need to be reported separately. This slide gives you a visual presentation of some types of expenses that are excluded from the Medicare wage index. Any salaries and hours that have been capitalized should not be included. Physician Part B services and non-physician Part B providers, such as CRNAs, physician assistants, and nurse practitioners, must be excluded. Expenses for interns and residents are excluded, as well as non-reimbursable cost centers. Home health, hospice, SNF, ambulance, organ transplant, and NAHI expenses are not included in the wage index calculations. So on the next two slides, we've provided a visual reference guide of the types of hours that are included and excluded from the wage index calculation. So please use this as a guide to accurately reporting wage index hours. Inadvertently overstating hours can have a significant negative impact on outcomes. So let's dive into employee benefit costs that are included in the wage index calculation in a bit more detail. As mentioned earlier, identifying and reporting employee benefit costs is a crucial step in wage index review process. The grid on this slide identifies key expense items that CMS would consider wage-related costs and thus would factor into wage index outcomes. Items not listed here cannot be included. The other wage-related costs or items that would have historically been subject to the 1% test, such as malpractice coverage, have not been allowable for around 10 years now. Next, we're going to look a little closer at one of the major wage-related costs, health insurance. So health insurance will likely fall into one of the following categories. Most common would be self-insurance. Less common would be hospitals that purchase their insurance coverage. So self-insurance expense would fall into two subcategories: instances where the coverage is administered by a third party and coverage that's not administered by a third party. If there's not a TPA, domestic claim charges must be reduced to cost, and reported costs must be excluded and must exclude any co-payments and deductibles paid by employees. Employee withholdings and contributions are employee costs, not hospital costs, thus would be excluded from the wage index. Also worth mentioning is that unpaid employee responsibilities are not allowable wage-related costs. So let's take a closer look at two of the main types of health insurance expense: self-insured with a TPA and purchased health insurance. This flow chart provides a visual representation of what expense can ultimately be included in the wage index review. A further look into health insurance costs on this slide reinforces that all charges for domestic claims must be reduced to cost. But this slide also details expenses not previously mentioned that can be included in your review. Costs for employee health services, for annual physicals and vaccinations, smoking cessation programs, weight control programs like Weight Watchers, diabetes programs can all be included if they're not billed to the employee's insurance. Another major component of wage-related costs are allowable pension costs. However, we must keep in mind that the trial balance expenses are not what is allowed for inclusion in the wage index. There are materially different calculations for pension costs included in your cost reports worksheet A versus allowable wage index costs. For wage index purposes, allowable pension costs should be representative of cash contributions made over a 36-month period to include the cost reporting period and the two prior periods. Now we're going to take a deeper dive into a hot topic of recent years, contract labor. But before we shift gears, let's launch our third polling question. Has your hospital had an audit adjustment related to contract labor in the past 3 years? A, yeah, all contract labor expenses were removed. B, yes, but only a portion of the contract labor was removed. C, no adjustments were made. Or D, unsure how contract labor was handled. So we'll give you a few seconds, a minute or so, to drop your polling question here, just to reinforce the fact that you need to answer 3 of the 4 questions in order to qualify for your CPE credit. We'll dive a little bit deeper into contract labor once we get a little bit more responses in, and we'll take a look at what everybody's flavor for the recent audits have been over the past couple of years. We're stalled out at 78. We know everybody wants their CPE. Let's get it in. I'll give you about 10 more seconds and I'll kick it over to the responses. Okay, let's check it out here. So looks like no adjustments. A lot of us were unsure. Yes, all contract labor was removed is 6%, but I'm sure those 6% know that that was hugely, or it could have been hugely detrimental to the outcomes. So we'll dive into that a bit more here as we progress. Next, we're going to look at some of the basics for contract labor cost capture. Contract labor costs must be recorded on your cost report's trial balance as an expense and be reported as non-salary expense on worksheet A, column 2. Please keep in mind that this may differ from your financial statement presentation. Those contract labor costs could be in salaries. Contract labor expenses should be reported in the cost center that benefits from their services. So an example of this would be if the emergency department experienced contract labor expense during the year, that cost must be reported in the ED and not in an administrative cost center. During audit, the minimum requirement for supporting documentation is the contract with the vendor itself. And ideally, the contract would specify what the hourly rate or rates are and outline the terms of any non-labor costs. So expenses for meal stipends, travel expenses, housing expenses must be excluded from the wage index. Vendor contracts should include language that extends the terms of the contract to any subcontractors that they may utilize to provide services. And important note here that vendor contracts should be maintained and updated on an ongoing basis. To reinforce the basis for claiming contract labor costs, it should be representative of hours worked and must exclude non-labor related expenses such as meals, travel, lodging, equipment supplies, and any other overhead fees. If these types of expenses are buried into vendor invoices and reports, you will need supplemental reports from the vendor to carve out any non-labor related expenses. Another thing to remember about contract labor is that not all contract labor expenses can be included. We previously mentioned that there are cost centers such as home health and hospice and non-reimbursable cost centers who are excluded from the wage index. And similarly, any contract labor expense reported in these cost centers must also be excluded from the wage index. So in addition to the areas that are excluded from the wage index, contract labor for certain types of employees, such as physician Part B, nurse practitioners, PAs, CRNAs, audiologists, speech pathologists, nurse midwives, registered dietitians and nutrition professionals, dentists and oral surgeons are non-allowable contract labor expenses for wage index purposes. And just lastly, a sub-note that I'd like to mention that there's a common misconception that fiscal and occupational therapists can only be Part B providers in a private practice setting, but they can also function as such in a hospital setting. And costs may be disallowed during audit, but they should be considered an allowable expense. And respiratory therapists are not Part B providers and can be included in the wage index. So let's begin to discuss how different types of contract labor are reported within the wage index. So direct patient care contract labor is reported on line 11 of S-3 Part 2 in your cost report. Some common examples of types of employees providing patient care contract labor include nursing jobs, diagnostic jobs, rehab jobs such as rehabilitation assistants, therapeutic jobs such as infusion techs, pharmacy jobs, and jobs in lab areas. When capturing direct patient care contract labor, It is also vital that contracted interns and residents that you reported above line 11 on S-3 Part 2, line 7.01 are also reported on line 11, as neglecting to do so will have a negative impact on outcomes resulting from wage index allocations. So contract labor, top level management and other contract management expenses are reported on S-3 Part 2, line 12. And these costs would include expense for contracted CEOs, CFOs, COOs, and nursing administrators. Expenses reported on this line would also include costs for non-physician department directors, administrators, managers, ward clerks, and medical secretaries, but not if the other contract management services mentioned above are reported on Worksheet A, lines 26 through 43. Contract administration in general must be reported on S-3 Part 2, line 28, and these expenses must be reported on Worksheet A, line 5, or its subscripts. Examples of A&G contract labor would include legal fees, accounting expenses, tax services, consulting services, and IT-related expenses. An example of an expense that should not be included in this bucket, but oftentimes is, would be medical records costs, as they would be reported on Worksheet A, line 16, likely. And the last type of contract labor I'm going to detail is contracted physician Part A time, which is reported on S-3 Part 2, line 13, and possibly lines 15 and 16. So expenses in this grouping should include physician admin services for medical directors. Medical director time can be supported by detailed invoices and contracts. And if there are no time studies or contracts available to support the Part A time, it will be assumed that the physician comp is 100% Part B. Emergency department physician standby time can also be included as contracted Part A time. But supporting this expense as allowable requires following the same regulations a critical access hospital must follow while reporting ED availability. And during audit, you must be able to provide a reconciliation between the wage index and cost report work paper A2, provider-based physician adjustments. Lastly, home office or other related parties contracted physician Part A time would be reported on the line 15 series, and contracted physician teaching expense would be reported on the line 16 series of S-3 Part 2. Okay, I'm going to pass the presentation back to Brian Restivo to discuss some wage index best practices and things to be aware of during any subsequent audit proceedings.
Thanks, David. I appreciate it. We're almost getting down to the finish line. So, yep, we'll get the slide in the right place. Some of the stuff seems a bit rudimentary, but I like to go over some best practices typically on these because sometimes they get lost in our day-to-day. And some of these simple things that we can work on will make your lives a lot easier as you work through an audit or as you're compiling your data. The biggest first step that I highly recommend is actually reconciling your payroll to your trial balance. There's been countless times where we come in to help clients or do the work, and the payroll report's off by millions or missing substantial amount of data, departments and units altogether. So a lot of times what happens is there's a lot of work done, and then we have to realize when we get to the finish line that we're missing all this data and have to go back and restart it. So very critical to kind of go through a reconciliation to your trial balance. Now, the key thing to remember is your payroll reports are not on an accrual basis and your general ledger is, but there still should be some variance, albeit very small. The things to keep in mind, and it should be able to be segregated out in your journal entries is your last pay period accrual. So you're accruing for expenses that are going to get paid out in the subsequent period. Bonus accruals are sometimes accrued out at the end of the year, and those may not hit payroll to the following year, and they can be pretty large sometimes, and they're issued towards the end of the year. And other things like PTO accruals, and not shown here, capitalized salaries. So capitalized salaries I'll talk about in a little bit. But again, one of my biggest recommendations as you're preparing your data is to kind of go through this step of reconciling. And that'll help your compilation be easier and help your audit out as you get through it. There's a lot of times you'd be surprised that some of those payroll reports get cut off or they're missing things due to certain criteria that's on those reports. Another thing we gotta be mindful of is how costs are reported on worksheet A, your salary costs. You got to make sure there's no benefits in your first column where the salaries are supposed to be. Same with contract labor. So everything that's in column 1 on your cost report on worksheet A has got to be salaries. You can't have anything else in there. The other thing that's very critical is that bonus pay and PTO time must be reported on the cost report line in which those salaries are reported. In other words, you cannot have bonuses and PTO booked to a HR department in general because it's easier for your cost reporting, for your internal reporting, because by the regulations, those costs have to align to the cost report lines that the salaries are associated with. So we've seen a lot of work over the years where this bonus pay and PTO pay has gotten really aggregated into one department, and it gets lost in translation and doesn't make its way into the wage index or gets disallowed. So it's critical that these types of pay follow the employees' salaries. So on here, other considerations that we see kind of missing sometimes is that folks are reclassifying salaries on their cost report, but they are not reclassifying the hours. And so you have a mismatch of dollars and hours. So you want to make sure that if you're moving any dollars around on worksheet A6, that those hours follow with it. The other thing too that gets caught up is capitalized salaries, and this will harm hospitals. And the MACs have done a good job trying to make inquiries about this, start their review process. Since salaries that are capitalized move into construction in progress, they don't show up as salaries on the trial balance anymore. Therefore, those salaries are not in your worksheet A column 1. Now, you cannot include capitalized salaries as part of the wage index. However, what will happen is hospitals typically will overstate their hours because those dollars and hours on the payroll report will show whether or not that person had capitalized salaries or not. So what happens is you have no dollars and you're including hours in those cases. So it's critical to make an adjustment for anything that gets capitalized. We see a lot of this with IT implementations where salaries are being capitalized a lot more than historical. So very critical to connect with other folks within finance on large capital projects to see what salaries are capitalized and how you're tracking them, because what you don't want to run into is overstating your hours when the dollars aren't there. So the next thing we kind of see a bit is how folks are allocating their benefits, and kind of the default way to allocate benefits has always been salaries, but that's not necessarily the best practice in how a hospital actually incurs the cost. And what happens when you do it based on salaries is you end up pushing too much benefit costs to physicians and advanced practitioners because they're a higher wage. However, when you think about how hospital or health system incurs the cost of benefits is how you should really be allocating it. For example, your health insurance costs are typically based on covered lives or FTEs, not how much an employee makes. So if you're allocating health insurance benefits based on salary, a doctor is going to get more of a health benefit cost than any other worker, and that may not actually be how the cost is incurred. So you want to try to mirror how your institution is incurring that cost, and there are certain instances where it makes more sense for salaries to be used. for example, retirements sometimes based on a percent of your salaries, but be careful of overusing that method because it could cause you to be out of whack. And when you think about physicians and nurse practitioners and advanced practitioners, that the benefit allocation between those job codes typically would yield a lower percent of benefits to salaries just because of the higher wages. So if you think you have an opportunity, you've got to submit a request to your MAC to change any methodology of allocation from the prior year. So be very mindful of the timing and when you need to make those notifications to the MAC. Sometimes the MAC will go back to salaries as a default because that's what's in the request report instructions. However, you have that ability to make that change if you submit that request in. So keep an eye on that as well. We typically see that as an area of concern or risk. Have it. So with that being said, I'm going to kind of get ourselves to the last polling question here and take some time to wrap things up for today. So we're going to get this last, if you need that last question for your CPE credits, we're going to push this across here. And when was the last time you had a third party review your wage index data? Again, we asked this probably because having an extra set of eyes is always a good thing because people have become complacent sometimes with some of the rudimentary stuff of the wage index and things don't really follow how the operations have changed at your facility. So new payroll systems, new HR policies, new pay policies, all those things and changes, especially post-COVID, of how people are paid are driving a lot of changes in wage index. So we typically see a lot of errors in the last couple of years as we're reviewing data. Audit adjustments are up from the max, understandably, as the reliance on contract labor has increased. So try to get a sense of how many folks have had a separate set of eyes look at their wage data. So we'll give some folks a little bit more time here to get some last minute polling questions answered. And just to kind of give everybody a heads up, you may or may not be aware of some of the changes coming through from CMS regarding provider-based departments. And I know that is not necessarily the topic today, but the wage index actually does impact provider-based department reimbursement for off-campus locations and new attestation requirements beginning January 1st of 28 is kind of right around the corner. So we're going to have an alert that's going to come out here soon with some information surrounding the provider-based department attestations. That's going to hit our website. So be on alert for those details, and it should be hitting your inboxes at some point this week. And subscribe to our healthcare updates so you guys are making sure that you're keeping up to date with all the change in regulations, not just wage index changes, but provider-based attestation and other compliance changes. It's an ever constant, ongoing challenge to keep up with all these changes. So we'll get the polling questions up and then answers up. So it's pretty close between all the different buckets there. So interested to see. And with that, I'm going to turn it back over to Emily to kind of wrap us up real quick on everything else.
All right. Thank you so much, Brian, David, and Brian, for a great presentation today. We are out of time for questions. However, you can still submit them and we'll do our best to follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance. Thank you for joining us, and we hope you'll join us again next time.